This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On this week's show, what will you do when trouble arises? Do you really remember previous market collapses? And do you know how you'll react to the next one? This week, we'll try to get you ready. Welcome to the Wise Investor Show. I'm Chase Hinderstein, and it's been a few weeks, I think, since I've been on the show. So I'm going to use today's show to talk about Black Swan events, as if my recent podcasts haven't been negative enough. But really, it's definitely not a show that's trying to predict a Black Swan event. I'm going to say that over and over again. But this is instead, it's a reflection on what they are, how they happen, and really importantly, how you should react to them, how you should prepare for them so that you can be mentally prepared to not panic, don't jump in with the lemmings, and don't do lasting damage to your portfolio when they happen. I do remember quite a few of these in my day, depending on how you define them. I have distinct images and memories from, maybe a half a dozen or so of these types of events over the last 30 years. And they're all shocking. They're all really big when they happen. And as we'll talk about a little bit, when you look back on them 5 years later, 10 years later, it's almost as if they didn't happen. Most recently, during the early days of the COVID pandemic, not only do I remember the images in the news, and I have still screenshots to remember what the markets are capable of doing in a single day when they get really troubled, and also how fast they can be reversed. I have a picture on my phone of my quote screen from March 24th of 2020 when the Dow was up over 1,100 points. Everything on my screen was green. It was a great day. And it pairs nicely with the pick from 12 days earlier, March 12th, when the Dow was down 1,700 points for the day. But for the sake of this podcast, I'll share with you a distinct memory I have of one person who, in those early days of COVID, the person who was really in a real panic. And there were lots of people panicking. Like I said, we all were to some degree. But this person really, they called over and over again, and they spoke with me and my colleagues more than once a day, multiple times per day. And in the end, despite our advice and our descriptions of their allocation and the balance and the relative exposure to risk they had, they said, well, I'm not panicking here. I'm just trying to be strategic. I want to sell all my stocks right now, and then I'll buy them back in when the market has stabilized. And end quote. That's almost a verbatim quote as best as I can remember it. And of course, ultimately what happened is that they were within a day or so from a very sharp and very distinct bottom in the market then. And not long after, when the market was up more than 20% from that day, well, then they were ready to buy back in. That was their example of stabilization, was the market returning 20% higher. And the market, which snapped back in just a few weeks after making that low in March, it started making all-time highs 4 to 5 months right after that low was put in. And this issue was unusual. And after the low was made for the great financial crisis back in 08 and 09, again, this time it was again in March of 2009, it then took almost 4 years to exceed the high, which had been previously achieved in late 2007. But if you weren't fully correlated then with the overall market in 2008-9, if you weren't fully exposed to the market, then you, of course, likely didn't suffer the full downside. And you made your own all-time highs. You recovered in a pretty short period of time. But I'll get back to that. But back to this person that did panic in 2020. That wasn't a frequent outcome. It was unique, thankfully. But the emotions that were driving them were very common. Reacting that way does lasting damage that really can never be recovered. So the point today is to visualize the experience and be prepared to endure it, not try to avoid it. That's, I guess, the message here. Know how you endure these events. Don't try to be smart enough to avoid them. We want to cultivate the ability we have to exploit these events, as what they really are is irrational pricing of assets, which you thought were worth a heck of a lot more just days earlier. And in anticipation of this week's show, I do this every few years or so, I shared, because I find it very reassuring, I shared an old clip of Sir John Templeton on Louis Rukeyser's Friday night Wall Street Week show on PBS, if you remember that. That show was so much healthier to watch than watching CNBC all day. And this multi-part clip, which was broadcast on the Friday after the Black Monday crash in 1987, you should check it out. You can find it on our Twitter feed, or you can look it up yourself on YouTube, and try to just hear John Templeton's sane and calm voice in your head when the markets start getting irrational. And this can help you start or stop from being sucked along with them. If you can be prepared for these events, you can then sit back, or perhaps you could take some advantage of them by buying assets on the cheap, but only if you have some dry powder. But the risk of that bit of advice is that you cannot and you must not try to overdo cash hoarding trying to anticipate these events. They don't occur when you think they do. That's by definition. You can't anticipate them. And when they do happen, you then, this is even harder, have to be really bold and really call anything near the bottom and then jump in. And at that point, you're not going to be inclined to commit enormous amounts of cash. So if you've got all the cash, then on those lowest, darkest days, you really probably are unlikely to be pulling the trigger now to put it all at risk again, because you're even deeper in your bunker at that point. Conversely, if you, during a period of irrationally positive market behavior, if you took on an allocation to risk that itself was too aggressive for your own needs, you put cash into risky assets, cash that you might need to instead call upon in the next 1, 2, or 3 years, then you've set this trap to be forced to sell along with the pack when good assets are being blown up with the bad assets. Because when these real drawdowns occur, at the worst of times, you can't expect great companies, ones that may be at reasonable valuations, ones with fortress-like balance sheets, you even can't expect them to be immune. You may expect them to lose a bit less or to rebound faster, but during the worst of times, when major portfolios are experiencing forced liquidations due to redemptions, or worse, maybe due to margin calls, then those portfolio managers aren't going to be able to raise that cash they need by selling the worst of their holdings. They're instead forced to sell the strongest, as well as everything else. It all starts to take a hit. That's another characteristic of these types of events. So for the average investor, even one who isn't overexposed to risk, the danger is, of course, acting impulsively and emotionally to either contain the losses that even a conservative allocation may be enduring, or maybe just solely as an emotional response to what they're witnessing. Even now, we're starting to see some elements of this today, which is kind of what brought this subject back into my mind again. Not because we're seeing terrible losses in the markets this year, although they haven't been great lately, but because sometimes an element of this is just the emotions on their own. Right now, the headlines are pretty terrible, regardless of your own perspective or stance. If you're looking at our domestic news right now, or of course the global news, it's not a portrayal of the Rose Parade or kids dancing around the maypole right now. Even if these headlines aren't financial in nature, and surely even if we have the risk of things getting substantially worse, they still don't have a meaningful impact on many companies' earnings over the next 2, 3, 4 years, how much soda they may sell or cash flow they may be producing. But people at times feel powerless in challenging times, even ones that are not financial. It just you feel powerless watching all this news. And one way a person can exhibit some power, even though they shouldn't, is to take action in their portfolio. Now, you may be able to make an economic argument as to why the troubles in the Middle East could have an economic impact. And, those arguments wouldn't be completely incorrect, of course, but still, the reactions aren't really to these narrow ends, but instead to the horrors of the world we face, the turmoil in our government and the troubles on our own streets and our schools. And emotionally, folks often react by looking to reduce the risks in their allocations, despite them already being conservatively positioned and not correlated with the troubles that are ultimately driving these emotions. So be on guard and reflect on your thoughts as we see these things happening in these markets. See if there's any truth to this, where you may see some really disturbing events, whatever they may be, and your mind starts to drift to your stock portfolio, really for lack of having any other way to react anywhere else. Okay, so that's the case for how to be prepared psychologically for a black swan event in the markets. Not because one's coming, or not because we think one's coming, but because you cannot know when's coming, and you must always be mindful of your allocation and of your behavior. How much cash and short-term instruments do you have on hand to weather a storm if we get one? Do you have enough so you don't touch your assets until it's passed? How will you react when it starts popping? Are you going to see it as irrational when it happens, or are you going to jump in with the masses and throw yourself off a cliff with the lemmings? The world looked pretty darn bad in March of 2020. Horribly. There were lots of body bags in photos, and businesses were all shuttering. But it was not only the sharpest downturn in history, but it was also the sharpest recovery in history. The great financial crisis, believe me, it felt like to me it went on forever. But the worst of it, the real worst of the markets, really only lasted about 6 months. And a balanced portfolio was often recovered about a year or so later. The Russian ruble crisis of 1998 saw a 24% drop in the Dow in a month, and most folks don't even remember it. I remember it was the first time the New York Stock Exchange traded 1 billion shares in one day, and at the time, folks didn't even know. We couldn't tell, like, was I out of the stock, in that stock? The executions were all messed up because the volume was unprecedented. Total chaos, and also fully recovered in just a few months in that case, despite the monumental collapse of long-term capital management, which drove a lot of that turmoil. It always feels like this one's the big one, and we always I hear this so often, I don't have enough time to recover from this at this point in my life. But in practice, that's never the case unless you're really unprepared for it, and if you also overreact to it. So now that we've covered a bit of how to be prepared for it, how to steel yourself for it, after a quick break, I'll talk about what you can do if and when it comes, and maybe a little bit, without predicting one, why we are ripe for one right now. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Don't be forced to sell stocks in a bear market. Now is the time to review your financial plan and determine how much liquidity you truly need. I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know. To learn more about how to manage your cash flow and to become a better informed, wise investor, listen to the Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. So I keep saying over and over again that the point here isn't to predict a catastrophic market event. That is just not our job. There are, unfortunately, folks out there who do try to sell fear and they make claims about their versions of the end of the world, or at least capital markets collapsing. And, they're telling those same tired stories year in and year out with very little variation on the theme. They don't even have to update them. They just keep selling them because fear is compelling for a lot of folks, and it sells. And they're often, the worst of them, some of these are really nefarious actors. They're selling products with very high fees and ill-conceived advice attached to them, while others are just really tired old takes that are rarely updated. They're not as ugly as those that are trying to capitalize on it, but they just tell the same tale year in and year out. CNBC likes to trot out one fellow who, he's on there every few months or so. Anytime they want a negative take on China because China's in the headlines, and they bring him out because he's been negative on China for 20 years. And they call him a hedge fund manager, but he really has barely any assets under management. I don't know if he has any beyond his own. But they give him this prominent moniker, and they bring him on to tell everyone why this is only going to be the beginning and it's going to spiral into a disaster, which he's been saying for 20 years because he really hates the Chinese economy. And CNBC does well by being hyperbolic about situations like this because it holds your attention when they do so. So I don't want to be confused for this show's not supposed to be me looking into a crystal ball and seeing a storm on the horizon. But beyond being always prepared for trouble, like trying to be the Boy Scout of investors here, I do also want to acknowledge that conditions are a bit elevated for this type of risk right now. And also, very importantly, I believe we're collectively better prepared to combat the trouble now than we've been in a very long time. I've been saying all year, lots of things to encounter in the headlines, economics and beyond. But my biggest challenge as an investor, moving beyond the headlines and moving even beyond the Fed, what I struggle with is that the S&P 500 is trading at 19 times next year's aggregate earnings estimate, and that estimate is based on a 12% earnings growth rate for next year. So we'll have to see there, but that's where I'm a little skeptical. But I also will reflect today that the equal weight version of the S&P 500, instead of the market-weighted one, which is the one that we all tend to use as, which is radically overweight those big tech names, but the equal weight version of one, as a proxy for the overall market, it's actually trading at just over 9 times next year's earnings right now. Now, recognize that this version is always at a much lower multiple because it factors in equally. The big cyclical names, the utilities are in there just as much right alongside the big tech names and even the consumer staples names, which are trading at really kind of crazy multiples right now. But I'll leave that story for Simon some other time. But this version of the index is cheaper now than it's been in quite a few years. So depending on what angle you use to look at the market, a lot of bad actually has been priced in lately. You probably can see that with some of your recent statements. But depending on how you look at it, the market may be somewhat pricey. And when you're busy painting your house from the highest rung of a ladder, you don't really want to stretch out as far with that brush as you do when you're much further down that ladder. That's supposed to be an analogy for risk exposure. When the markets aren't really cheap, then you don't take on extra risk by reaching out further. You play pretty close to your chest, to mix metaphors here, because when the market's expensive, you are more susceptible to more dramatic sell-offs than when the market is already at a discount. However, along with that comes a lot of good in that we're pretty capable today of fighting the fire these days. That is why you don't want to jump out to avoid a drawdown, and you don't want to believe that you can get back into it at lower prices. The Fed has caused a lot of turmoil in the markets by raising rates by about 5%, but by doing so, of course, they've also filled up their quiver of arrows here with 500 basis points of ammunition to combat problems that might arise. We're also still seeing very strong home sales, including this week. We saw a better than expected number for existing home sales, which is the area that I am pointing out is suffering from a very low inventory issue. And of course, we're still living with a very full level of employment, albeit now with far fewer empty job openings than we had at the peak a few years ago, which is what Jerome Powell pointed out this week. So there's a cushion against the worst of economic carnage, and there are, I think, sufficient or at least substantial weapons to fight that fire. What we're seeing happening, the threat of the U.S. government closing and, of course, the horrors of both the war in Ukraine and the Middle East, could actually be doing, and I don't want to be perverse in saying this, but everything that we're now confronting is doing the last of the Fed's work for them. And if it gets worse, it could really start to end the inflation issues we've been hammered with. And while a really ugly market is no fun to endure, please remember that we have the tools to turn it around, because it's going to be hard to think about that when it's happening. If you can, then at least you can avoid panicking when it's happening, and you can avoid throwing away the companies and the assets which you admire, and you don't want to throw them away at prices which you would have otherwise been killing to buy them at. If it happens, we can't know when it will end, but we won't know when it will turn around. Will it be 2 weeks later or 2 years later? But if you're prepared, you could sit back and hang tight, or you can nibble. You can nibble at the names who fundamentally really aren't affected by what's driving the troubles. Their stock price might be, but are their revenues being affected? Are their earnings being affected? The troubles which you can't believe won't be here, and you have to believe in these names, are going to be producing earnings and growing dividends in the years to come. It's not a winning proposition to wait and sit on your hands for 8 to 10 years for these things to happen. That's not a strategy here, because on aggregate, if you do that, you're going to just leave too much return on the table in the meanwhile, and you're really unlikely to jump in with enough gusto when you finally see it. Don't believe for a second that that's what Warren Buffett does, because those folks there over at Berkshire, they're always looking to deploy capital, and they're buying year in and year out to different degrees in different areas. But when it gets really nasty, then you really want to try to convey and think about or like Buffett or John Templeton, and really try to use some of your own stored strength to gobble up some bargains. All right, that's all for me this week. This episode might not be particularly useful anytime soon. In fact, I hope not. But these are ideas that I try to float out there every few years. So hopefully at some point, if it's needed, this will provide a sane voice that you can reflect upon, as at those times, financial analysis really doesn't serve us as much as a level-headed take on what's before us. So I hope if it happens, you can at least use it as that. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.